Hi guys, Ben here and welcome to Motivation to Invest. Ray Dalio is one of the greatest investors of all time with a net worth of over $18 billion. As founder of the world's largest hedge fund, Bridgewater Associates, he manages over $160 billion in assets. He has beat the market multiple times and is one of the leading thinkers on investing principles. Due to his intelligent understanding of economics and unique diversification strategy, he has managed to predict multiple stock market crashes, from the financial crisis in 2008 to the 2020 stock market crash. So in this video, I'm going to reveal Ray Dalio's top 15 rules for investment success. You will learn everything from portfolio management to self-awareness and the psychology behind investing. If you appreciate the hard work which has gone into compiling this video for you guys, go ahead, smash that like button for the YouTube algorithm. In addition, feel free to subscribe to this channel if you want more stock market investing tips and exclusive stock picks, which I personally have invested into. With that being said, let's dive in.
You guys have an extraordinary track record of winning.
Yeah.
Is it harder to compete in the markets today than it has been since you founded Bridgewater?
No, I don't think so.
Really?
Not the way we do it. And the reason I'm saying not the way we do it is we don't take systematic biases. I think for a lot of people, they're systematically long everything, you know? And so we have a world in which when the world gets bad, it's bad for them. In 2008, it was great for us. I don't know, we had nearly a 10% return in 2008. So we have the opportunity to go either way. We just may be wrong if we're wrong. So I'm so scared about being wrong that it has helped reduce my chances of being wrong because I'm so scared. I won't take bets that that I don't feel good about, and we diversify our portfolio, and that's how we have the track record. I was just commenting in terms of,
I see.
Let's say, you asked me about investors. So I'm trying to go back what an investor should do.
Well, and what you think is appropriate for your
here's
investors, what you guys are doing.
Well, I want to just convey to investors. I think in the average investor, most everybody, don't compete against pros like ourselves or other people. Don't making tactical asset allocation bets or moving around in the markets because you're probably going to lose. It's difficult for us.
Just buy beta for 15 basis points?
No, you have to have a balanced portfolio. In other words, think about how you're going to have a balanced portfolio. What you know is that asset classes as a whole, over a period of time, are going to outperform cash. Mm-hmm. Okay, that's the most thing that you could be most comfortable with. If they don't, you have a depression. The only times that hasn't happened. But to know how to achieve a balanced portfolio, and that's a whole other subject I don't know that you want to go through. If you're talking about tactical bets, in other words, I can come on the show and I can say, I think this is good. But then what happens is if I come a month later and I then change my mind because something has happened, then I'm going to mislead people. So the tactical bets I don't think are going to be helpful. I would say that we're in an environment in which it's very important to have a well-diversified, and that'll include assets like, to some extent, maybe a little bit of gold in your portfolio. In other words, what could I tell investors? Try to achieve balance in various ways. That's a whole subject about how to do it. And also, I think that, gold, at 5% of your portfolio, 5 or 10% of your portfolio, under the circumstances, would be also a prudent thing to do. Prudence is the important thing to do. The reason I'm also referring to that is we have a situation where a debt is money. In other words, we have a fiat monetary system too. And so we're having problems as these central banks operate. And so think of it as another form of cash. And when cash now has 0 or 0% interest rates or less, think of it as one of those possibilities in terms of how do you create diversification? Well, we break it into two parts. We have two basic portfolios. There is the strategic asset allocation mix, which we call all weather, and that just has nothing to do with bets. It has to do with how to make all the assets the same risk parity. I would call risk parity. The problem is when people try to diversify and they own some equities, and equities has a volatility that's large, or they own assets that do well when the economy does well and do badly when the economy does badly, they have a concentration of their risk in some assets. They need to change the portfolio. They need to buy longer duration bonds or leverage the bonds or bring up so that bonds and commodities and pieces have comparable impacts so that whatever happens in the economy will then have a balancing effect. Because the one thing you could be most confident is that asset classes on average will outperform cash.
Okay.
So if you have, that's a strategic asset allocation. That's what the all-weather piece is. Then there's the bets. The bets are zero sum, right? In order for you to beat me in the game, you're going to, it's like poker. It's a zero sum game. We have 1,500 people who work at Bridgewater. We spend hundreds of millions of dollars on research and so on. We've been doing this for 37 years, and we don't know that we're going to win. In other words, we work that. We have to have diversified bets. We have a lot of diversified bets and so on. So it's very important for most people to know when not to make a bet. Because if you're going to come to the poker table, you're going to have to beat me, and you're going to have to beat those who take money. So the nature of investing is that a very small percentage of the people take money, essentially in that poker game, away from other people who don't know when prices go up, whether that means it's a good investment or if it's a more expensive investment. That's that, the people who feel like I'm good, I've got it, won't learn. If you've got it, you won't learn, right? So you have to get rid of this ego barrier, I've got it. Ordinarily, there are two ways of making decisions, pretty much. There's the boss has control, and so
Autocratic.
Autocratic, I'll call that autocratic. Takes in everything and then he makes a decision. Or there's democratic, pretty much, one man, one vote. But really, the best decision making is believability-weighted decision making. And if you think about it first conceptually, you would say, if you're going to make a decision of what you have a medical condition, and how are you going to get that? You're going to think, who are the best doctors?
Consult the experts, right?
Consult the experts, but this one knows more and that one knows less, and how do you do it? And then you have this triangulation, and then you make that. That's kind of the idea of believability decision making. We have ways of assigning believability that we all agree are fair, that we each assess each other, and we get certain amount of believability points. So now imagine that you had your believability on a subject matter. Maybe it's investing, maybe it's accounting, whatever the subject is, that you have a certain amount of believability-weighted points, and you're together. Well, those believability-weighted points, when you say, okay, what should I make as a decision? Now I'm responsible for something, but I ask everybody else, and I take a believability-weighted vote. I can have a believability-weighted vote. When I have that believability-weighted vote, I really do believe that it's going to be a better decision than I would individually make. That's believability-weighted decision making. And it's fantastic when you have independent thinkers. In order to be successful in the markets or as an entrepreneur, one has to be an independent thinker that makes decisions better than the consensus decisions.
It's fair.
In the markets, the consensus is built into the price.
It's beta.
Yeah. So now you have to bet against the consensus to make money. Therefore, you have to be an independent thinker. The best dynamic is to have a bunch of independent thinkers. Now you've got a bunch of independent thinkers. How are they going to have thoughtful disagreement and get past those disagreements? How we have done that is the key to our success, and it's outlined in the book.
Anticipated the financial crisis, managed your clients' funds through that period. Make the argument that your culture actually has something to do with that result.
Well, first of all, I think that, well, I'll tell you what the moment was like. You do our calculations, and we have a view that's very different than the rest of the world's view at that time. So the independent thinking, we had among ourselves different people who had different views, and the ability to work ourselves through those was essential for us to being able to stand aside from the crowd. So I needed to have the independent thinking, and we needed to work it through. And then even at that time, we had to have the fear of being wrong, because you can never be confident that you're right in the markets. And so to place the bet, but to place the bet in a defensive way, and to work out together the engineering. What I believe is that everything happens over and over again through history. The world operates like a machine. It happens over and over again. And that if you can sort of go above yourself and your circumstances and look down at yourself within your circumstances within a historical perspective, and then have agreed upon principles. You know, principles are how to handle things that happen over and over again. By having that, it's helpful, and ours are just oriented around this idea of meritocracy, so it allowed us to have an independent point of view while being not 100% certain, and, you know, to be defensive, and it allowed us to play that well. When I was 12, I hated school, but I fell in love with trading the markets. I caddied at the time, earned about $5 a bag, and I took my caddying money and I put it in the stock market. And that was just because the stock market was hot at the time. And the first company I bought was a company by the name of Northeast Airlines. Northeast Airlines was the only company I heard of that was selling for less than $5 a share. And I figured I could buy more shares, and if it went up, I'd make more money. So that was a dumb strategy, right? But I tripled my money. I tripled my money because I got lucky. The company was about to go bankrupt, but some other company acquired it, and I tripled my money. And I was hooked. And I thought, this game is easy. With time, I learned this game is anything but easy. In order to be an effective investor, one has to bet against the consensus and be right. And it's not easy to bet against the consensus and be right. One has to bet against the consensus and be right because the consensus is built into the price. And in order to be an entrepreneur, a successful entrepreneur, one has to bet against the consensus and be right. I had to be an entrepreneur and an investor. And what goes along with that is making a lot of painful mistakes. So I made a lot of painful mistakes. And with time, my attitude about those mistakes began to change. I began to think of them as puzzles, that if I could solve the puzzles, they would give me gems. And the puzzles were, what would I do differently in the future so I wouldn't make that painful mistake? And the gems were principles that I would then write down so I would remember them that would help me in the future. You know, from a very early age, the whole idea of being right is so rewarded, whereas learning from mistakes doesn't have its place, right? So a kid studies, you're smart, you take the examination, and okay, you do badly, but life's not like that. Life is mostly a matter of making your mistakes and knowing how to evolve past those mistakes and learn.
You now use a lot of computer-related algorithms to help you navigate the market?
Yes, you know, algorithms are what we call them today. Equations is what we used to call them. And so you would write that down, and what I learned is by being clear, then I could tell how that decision would have worked in the past in all different environments, so it gave me a lot of perspective on making that decision. I could test it through the Great Depression and so on, and then I could find that if I use that same algorithm, I could take data from and have the computer make decisions in parallel with me. And so, this is what I recommend for everybody. I recommend they write down their principles and then realize that almost any of those principles can then be converted into algorithms. And so the computer was making decisions in parallel with me making decisions. That type of partnership between me and the computer, and also expressing the algorithms, was invaluable, not only in the quality of the decision making, but also the quality of the relationships that I had with the people I worked with.
Well, I sat down with the famous Ray Dalio, right?
Right.
And I prepared for 18 hours for that interview because he's a genius and there's not that much on him and I wanted to absorb it all. So I got every little bit of it, sat down with him, and it turned out Ray was a fan of my work, which I was touched by 20 years ago. I guess he listened to my program, so he was very generous with his time. And we spent these 3 hours, and in the 3 hours, when I got to the end, I said to Ray, I said, listen, I really want to help the average person, so I got a question for you. I did this with everyone. I said, if you couldn't give your money to your children, any of it, and all you could do would be give them a portfolio or a set of investment strategies or instructions, and they were going to start over and build it, what would it be? And he said, Tony, I spent a decade figuring that out. All my money's already there. My kids' money is there. My money from philanthropy when I'm gone is there because I'm not going to be here and I want something that'll do well in the future. And I don't know what the future is going to be. Markets are going to always change. I need something that could work in any market. I call it my all-weather fund. Most of us in the business are familiar with it a little bit. And so he explained it to me and I have a good understanding. And I said, I get it. So what you're saying is the reason why, this was obsessed him. Why is it if I have a balanced portfolio in 2008, I got nailed on both sides?
Exactly.
Why did that happen in 2000? Everybody says portfolio theory, this is supposed to protect me, and it didn't work. But he said, as soon as things get better, no one talks about it, we just forget about it. It happens again. Happened in 2000, happened in 2008. He said, I figured it out. When you have a 50-50 portfolio,
Right.
that's 50-50 of where you put your money in assets. 60-40, 50-50, however you look at balanced portfolio, right? But he said, the problem is that's not balanced risk. And this is where people are crazy. I've seen people write things up. They see this in the book and say, Tony Robbins is promoting. First of all, I'm not promoting anything. Every word in this book is from the best investors on earth. Anything that's from me is about the emotions. That I know for 36 years. That's been my expertise. These are their views. But I'll tell you what's amazing. He said, Tony, when you have stocks and bonds half and half, you're not equal because equities are 3 times more volatile. So your risk is 95.5. And he said, so that's why people get killed in 2008. And he said, I try to get this through to people. He said, but all of our people handle it. You know, you manage money for countries, the largest, pension funds on earth. He said, but people don't listen. They look at it and go, oh, this is bond heavy. The bond days are over because inflation's going forward. He said, it's not true, Tony. This fund in the 1970s, it was the worst time for bonds and it was an extraordinary time for all weather because it isn't. It looks overbalanced because in order to get the same level of risk, you have to go for more long-term bonds or you have to use more leverage on the bond side. And so when he was all done, it was, for the average person complex, I'm seeing financial people look at this and write things up that are just silly, saying, this is never going to work because we're in the, interest rates go, the only place to go. If interest rates go up, it's a balanced fund. The other areas kick in. But here's what's interesting. After he told the whole thing to me, I said to him, look, this is wonderful. You've given me something that very few people understand on the planet. I think I really got it. And I played it back to him. He said, you got it. I said, but here's the problem. The average person is never going to know what to do with this. And I said, I'm trying to help somebody that needs to know what to do. I said, you're telling me to make this beautiful chocolate cake, and you're saying, Tony, here's how to do it. Use some sugar, right? Use some chocolate, use some dairy products. I need to know the amounts, give me the amounts. He goes, Tony, that's my secret sauce. And that's when he told me, he said, look, 10 years ago, for you to even get in to talk to me, it was $5 billion net worth, $100 million to get in. And he said, and now for 10 years, I haven't taken anybody's money. And so you answered your own question. I said, you're not taking money anyway. It's not going to compete with you. The average guy, he says, never going to make it talking to a wealth manager. Tell me what to do. And he's so generous. He's giving up half his net worth like many other people. And in the end, he said, okay. He said, but it'll be complex. I said, I can make it simple. He said, well, I don't want leverage in it. I said, design one without leverage. He goes, it won't be perfect. I said, I don't care if it's not perfect. Your idea of unperfect will be somebody else's idea of the best thing they could do. And he laid out the numbers. We ran the numbers and used the same back testing. So you saw year by year how it really did over the last 75 years of modern investing. And here's what's amazing. Like all weather, similar. In 75 years, it's been right 85% of the time. What's even more extraordinary is the 15% when it wasn't doing well, when it didn't do well, its average loss was 1.6%, not 50, 40, 30, 20. Think of the last 10 years, the 250% hits. His biggest loss in 75 years was less than 4%, minus 3.95. And that was 2008 when the market exploded, down to 51% from peak to trough.
Here are the allocations
Yes.
in the book, which would make a normal person gag, at least initially. Stocks only 30%.
That's right.
Even though the stocks on average are supposed to gain, 9% a year?
Yes, 9.2.
Long-term treasuries, 40%.
Yeah.
Intermediates, 15.
I know.
Gold, 7.5. Commodities, 7.5.
Yeah.
Absolutely counter wisdom.
I know, and it's amazing. When I interviewed David Swenson, he wrote a book, and when he said the whole secret to success is to be contrary to what else believes. But the math on this is what works. Here's what's interesting. That looks like your heavy bonds, 40 and 15, 55% bonds. And it looks that way visually in terms of volume you are, but in terms of risk, you're not. You're making us here equally weighted. Think of it this way. What triggers things to grow is inflation or deflation in terms of price. Certain things do really well in inflation, certain do in deflation. Growing economy, shrinking economy. And he's figured out which quadrant you need to put each to actually have equal risk. And that's why it's done well. This year, this formula is done, it's 1% better than the market. It's in 13 in the third right now. But more importantly, 3 weeks ago when the market dropped and gave up all of its entire benefits for the entire year and everybody's guts were checking, there was no gut check because it went up 1/4 point. So the beauty of this is, I'm sure you know, there was a study done the last 20 years, and the study's from 1993 to 2013, and it's by Dalbar, and they found that the market, S&P 500, during that time did 9.2% on average, just as you said. But do you know what the average mutual fund owner got, investor? 2.5%. That's before tax. Why? Because we as investors always do the wrong thing.
Emotions.
That's right. We sell when we should hang on. We buy when we shouldn't. So the greatest thing that I think that Ray offers somebody the opportunity to do is actually stay in the market. Because if you got 1.6% as your big hit, if 4% was the biggest hit you've ever seen in 75 years, I think you could stay in and you can do what Jack talks about, which is stay in that market through time.
Of course, this means resetting each year.
It's a reset once a year. That's the one, recalibration. So 15 minutes a year and you're in the game.
So what happens with meditation, as you know, is it's just a simple exercise that allows you first to clear your head and then brings an equanimity to everything. Everything, it eliminates the stress, it eliminates the emotion.
And you do it how often? You're a busy guy.
Yeah, I've been doing it for 44 years, but I do it, twice a day, probably a third of the time, once a day, probably a third of the time, and not at all.
For 20 minutes, twice a day.
Yeah.
So you spend 40 minutes a day as part of your...
Oh, it's such a great investment. I would say that more than any other factor having any effect on my success, it's been meditation. Because the equanimity and also the creativity, because it opens between literally the prefrontal cortex and the amygdala, it opens the two sides of the brains and it allows a spontaneity, a creativity, an open-mindedness. And so it's good for not only the health, because you get stress is a terrible thing, but it also is very good in terms of the clarity and you don't get the emotional hijacking, and it's great for creativity. So it's helped me a lot. It's the biggest gift I can give anyone.
Okay, so if you didn't understand the economic stuff, meditate.
This is the biggest message that I think that I would get across, that I'm trying to convey in principles and so on, is that so many people have opinions in their heads that might be wrong, and they're too attached to them. And if you know how to operate with a certain amount of uncertainty and stress test your opinions in a different way, you get away from your ego, get away from all that. You can learn a lot about raising your probabilities of being right. So what it made me want to do is find the smartest people I could find who disagreed with me. And then I could have conversations with them.
Firstly, can you tell us, are you authentically satisfied and fulfilled? Do you have an experience in life of being successful?
I don't think that success is like a lot of people believe it is, and for any really successful person. I think that everybody's always struggling. And what happens is, you just struggle at a higher level. It's like learning how to ski or play some sport, and you're just kind of doing this higher thing, but it doesn't feel like that. It just feels like I'm struggling. And I think it's, and it's a good feeling. The way I think of it is, I've always thought that it's like, in order to be successful in life, you have to cross a jungle. Or you could stay on the other side of the jungle and not cross the jungle. But if you choose to cross the jungle has all sorts of things that can do you harm and bite you and everything along those lines. And so the best way to do that is to go into that with people who can see things differently and watch themselves and struggle to make it to the other side. And then what I've discovered along the way is that it's always a struggle, and I enjoy being in the jungle. I don't want to get to the underside. I don't want to get out. So that's what it feels like to me. The average person who's listening, too many people, think that they can go into this very difficult zero-sum game of betting against the consensus and be right. You know what I mean? In other words, investor says, I'm going to go in the markets, I'm going to make money.
Betting against the consensus and be right.
Right, because the consensus is built into the price. Okay? That's what's think of it as like going to a horse race, and there's handicaps. Okay? You're not going to pick the best horse, and you're not going to pick the best company. A terrible company can be a better investment than a terrific company. A terrible company could be a better investment, just like the terrible horse can be a better
what way?
because the odds that are changing, like you go into that and that becomes the long shot. But because the long shot is going to pay off 25 to 1, right? If he comes in, that you could just as likely bet on the long shot as the leader, and it's going to be equally likely that you're going to make money, right? Otherwise the market would be doing the opposite. Well, the market is like that, right? In other words, if everybody believes that something's going to be terrific, okay, then everybody's betting on it, and its price is high. So it's not what's best necessarily. It's what's best relative to what's in the price, what's discounted. For a lot of the buying there, and so the timing. Can you go to what you're like? Can you go to your mistakes? Can you go to your weaknesses? Right? Can you go to other people's mistakes and weaknesses? Some people, because of an ego barrier, can't do that. And so if they don't recognize their own mistakes, their own weaknesses, or others' mistakes and weaknesses, what the root cause being what they're like, because of ego barriers, if they can't go there, they're going to repeat those mistakes. They're going to have them over and over again. So it's the process essentially of saying at that stage, what am I like? Everybody has strengths and everybody has weaknesses. The weaknesses are the other side of the strengths. So let's say if you're a right-brained, creative person, you may not be reliable because just the way you think necessitates you to think a certain way. That means you can't think in another way. That means you're going to keep bumping into that thing that's standing in your way. But unless you can embrace, I'm not reliable, right, and deal with it, you won't get around it. It's still going to continue to be a barrier, right? So the diagnosis to the root cause is important. So then, if you diagnose it, then you have to design what are you going to do about it that works. So let's say you are very creative but not reliable. Okay, you have to find a means of, first of all, embracing that, and then saying, if I'm not reliable, what do I do? Do I work with a reliable person? Do I learn reliability? Do I have some compensating mechanism? Because I can't let that lack of reliability stand in the way of my goal. As long as I keep doing that, I'm going to keep running into problems. So you have to design what you do about the problems. And then when you're designing what you do about the problems, then you have to follow it through. So you have to follow through or do the thing you designed. And the doing the thing you designed requires self-discipline and so on. So people have to do those things in order to be successful, right? They have to know what their goals are. They will encounter their problems. They have to diagnose those problems down to the root cause, the real root cause. They have to design ways to get around them. And then they have to have the self-discipline to follow that. And it's a continuous iterative process. So that's what we keep doing, right? So you're going in that direction. I would say that all of the shapers are doing that. They're doing that well, right? So they don't mind the problems. They don't mind that. One sentence that I try to describe Bridgewater by, and it's meaningful work and meaningful relationships. This is what I want. Meaningful work and meaningful relationships through radical truth and radical transparency. So meaningful work means like we're in a mission together, we're excited about what we do, we want to do it excellently, that's meaningful work. Meaningful relationships are these relationships in where there's, like the honesty helps you. You can argue things through, but you always know that there's honesty and that there's mutual caring for each other. Radical truth means that knowing what is true, to be able to deal with reality, whether you like the reality or not, but to know what reality is. Like, imagine if you had a disease, would you want to know that you had that disease or would you not want to know? I'd want to know. And so to know, if you have a weakness, do you want to know you have the weakness or do you not want to know? Radical truth and radical transparency means you get to see everything. That's very powerful. It's the mixture of the elements that matter, right? If you have a tremendous tenacity, but you're studying, you're learning, you're trying to memorize and remember everything that you're being taught, and you're really trying hard, you could have great tenacity. You need the making sense of something. You need to embrace reality. You need these other dimensions, right? So I think the things that we started to talk about just before, the things that these people have a need for is first they need to most fundamentally make sense of things, which is a very different kind of learning process. It's a very internalized learning process. It's not a memory-based process. So none of these people, unlike the population as a whole, none of these people have a desire to follow instructions. For most people, you go to school, they tell you what class to go to, what classes to take. This goes all the way through university. They do this, do this, and then you go into the class and they say, learn this, and this is the information. And it's largely a memory-based, instructional-based process. This is not what these people do, right? This is not. So the path, what they have is a strong desire to understand and make sense of reality. How does reality work? You have no idea how you all see things differently. That there's a thinking spectrum. Some people are creative and not reliable. Some people are reliable and not creative. And as you start to give people personality tests like Myers-Briggs or the Big Five or different personality tests, you start to learn how people see things differently. And then when you see them differently, and that screen pops up where rather than just seeing how you see it, you go above that, and you're seeing that everybody is seeing things differently, it changes how you see things. Because it starts to make you think, how do I know I'm not the wrong one? In other words, as you go above it and you look down on all those different ways of seeing, you start to think, how do I know I'm not the wrong one? And how do I collectively see? And you see in a color range, it's like seeing in a different color range or going from 2 dimensions to 3 dimensions. All of a sudden you see the full spectrum of seeing things. And then you go to the higher level, and we have systems that go through the computers that go to the higher level that say then, how do we weigh all those ways of seeing to make the best decisions? So you don't get so attached to your opinions. I think the greatest tragedy of mankind is people holding on to wrong opinions that could so easily be rectified, and that's doing them harm because they're making wrong decisions. So how do you collectively do that? Well, the answer is by everybody seeing everything and seeing how others see, they begin to gain those perspectives. They also get to get an appreciation for the other way of seeing. It used to be that everybody would drive each other crazy. Your brain works in one way, my brain works in another. Maybe I see big picture, you see detail. Right. Maybe I'm creative, maybe you're reliable. We drive each other crazy. When you start to realize that people are actually seeing in those ways, and that's a valid way of seeing, and that I need you and you need me, and how to put together the team, as you're asking about, it gives you the evidence base. It's okay to be different.
Which of Ray Dalio's tips for success resonate the most with you? I would love to know your thoughts, so please comment your favorite below. I aim to reply to every single comment. If you enjoyed this video, go ahead, smash that like button, and definitely subscribe. See you next time.
Coming in, flex, I just wanna win, LABB who we running with, coming in, flex, I just wanna win,